Howdy, everybody. It is good to be with you today. My name is Brent Moores. We're talking about investing in dividend stocks today. And today, I want to tell you about 10 different things that can harm your dividend stock portfolio. So we're going to go through each one and hopefully help you out. I see some familiar names in the chat. Grateful for each of you to come out today and join me, spend some time with me. And if you're watching on a recording, that's great too. We're glad to have you. I'm joined by Scott Thompson in the chat. Appreciate Scott. So as you have questions, feel free to type those questions in. Between Scott and myself, we'll do our best to help you out. Now, you can follow me on X if you like, at Brent Moore CS. And before we get too far into this, let me just mention a few important disclosures here. One, the material today is intended for general informational and educational purposes only. We'll look at individual stocks today, but don't consider those to be an individualized recommendation or anything. They're just examples. And there are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying the dividends. We'll see some examples of that today. Schwab does not recommend the use of technical analysis as a sole means of investment research. We'll be looking at the paper money software application today, but that is for educational purposes only. All investing involves risks, including loss of principal, and past performance is no guarantee of future results. Risks of REITs are similar to those associated with direct ownership of real estate. Diversification does not ensure a profit and does not protect against losses in declining markets. Okay, there's that. Let's take a look. Let's head on over to the Thinkorswim platform. And I'm going to spend most of the time on the Thinkorswim desktop software today. Of course, a lot of what we can do, a lot of trading you can do is on schwab.com as well. In fact, we'll look at Schwab briefly today at least. But I thought I'd just take a look at the markets because we've had quite a big run up in the markets right now. We're above that 7,000 level, which is kind of this big psychological level. It seems like, will we hold it? I don't know, but we're up a little bit again today. I mean, we're at an all-time high in the markets, which, I think to a lot of us, we're scratching our heads a little bit given everything that's happening in the world. But just always keep in mind, the markets are forward-looking. They're forward-looking, and that's, I think, what we got to consider here as well. Now, I want to go through these kind of 10 items that I mentioned. Go through one at a time, and let me just, come on, and we'll do this. So, sorry, I'm learning how to type here. We're going to try this. Okay, so the first item on my list of 10 things that can absolutely hurt your dividend investing portfolio. And that's what we're talking about today. We're talking about dividend stocks. We're not talking about trading stocks short term, which I know we do in a lot of our webcasts. These are kind of longer term dividend positions there. And so the first thing I want to mention is chasing high yields without research. Okay, what do I mean by that? What I mean by that is this. When you first learn about dividend investing, one of the things that you learn is that it's nice to have dividends coming in addition to the stock price, and that very often the higher the dividend sounds better. But the problem is high yields can imply more risk. Let me give you some examples here. I want to take you to a stock here. So I'm going to take you to Lumen Technologies. Okay, I'm going to pull this up, and I'm going to go to a 5-year chart. So let's go to a 5-year chart on this. And let me just do this. We'll go to a 5-year chart, and I'm going to add a study on here. And it's a study I'm going to share with you, but it's a study where we can see the historical yield on the stock. Okay, so here's the historical yield, and I'm going to just apply that. I'm going to put it to the chart, and I'm also going to share that with you. For those of you who are live, I'm going to put that in the chat, number one. For those of you who are watching on recording, I posted it in the description of this webcast so you can get the historical yield there. Just remember, when we do, these scripts aren't guaranteed for accuracy or timing. But I want you to look at this. So this down here is showing the historical dividend yield of this particular stock, okay, Lumen Technologies. And you can see over here kind of the scale. And the scale may throw you off a little bit because when you look at it, you're going to say, these are really high numbers. Yeah, they are really high numbers. If the average dividend yield is 1%, maybe a little bit north of that, these numbers may seem outrageously high. Look at the yield here, though. I mean, it was about 7%. It was running about 7% back in 2022. It started to go up. Well, yields go up as the stock price goes down. If you blindly invest in stocks that pay a high yield, it can be very problematic for you because you can see what happened to the stock over that time. The stock just utterly crashed there. Well, were there warning signs? Yeah, declining revenues, that's kind of a warning sign you need to be aware of. And I'm not saying you can't have a revenue decline over, a quarter. That happens. But if you see consistently declining revenues, for example, that would be a sign. These high yields, when you see something like this, that can be a big red flag for you on that. Okay, so that's one I just want to look at there. That's one I wanted to mention there. Let me give you another example. Here's Walgreens. Here's Walgreens Boots Alliance. This is Walgreens. You guys are probably familiar with the store. There's probably one not too far from you, perhaps. And when we look at this, what you're going to see is we had a nice dividend, 48-cent dividend, 48-cent dividend. It was a pretty high dividend. They cut the dividend, and what's happening? The dividend actually went up high. Again, up 10%, 12%. And then all of a sudden, what happened? It crashed because they cut the dividend. That's one of the risks of dividend investing. If you have these high yields, and when I say high, what do I mean by high? I mean 7, 8, 9% or higher. That's a high yield. And you have to ask yourself, if a company is paying that high yield, there's clearly people who are concerned about that company. Because if there wasn't more risk with that company and it was paying a super high yield, people are going to buy the stock. And the stock price is going to go up. And when the stock price goes up, the yield goes down. So if the stock price isn't being bought up and you have that high yield, the people consider that to be a more risky type investment there. Okay? So that's the first thing I wanted to mention you there. Okay? So that was number one on my list there. Chasing high yields without doing your kind of due diligence on the company. Now, if it's a high yield company and it looks like and the fundamentals check out and there's no red flags, maybe it is appropriate. Number two on the list, ignoring the payout ratio. The payout ratio is the amount of money that's being paid out in dividends in relationship to the money the company earns. If the company earns a certain amount of money and they pay every penny out of that money they're earning into the dividend, that'd be 100% payout ratio. Most investors would consider that to be too high. I'm going to go a little quicker on this one, but let me just give you some examples here. Here's a company, VF Corp, that had a payout ratio back in 2022 of about 150%. Okay? That's a challenge. That's a problem. Intel, which has been in the news lately because it's just gone gangbusters lately. Well, look, Intel lately has been wonderful, but if you go back to say, let's do a 10-year chart. How about on this? Okay. Let me go back here. Let me just do this. You can see why, I mean, it was up at about 68, went down about 26, went down to about 20. Payout ratios were about 100% back in this time frame. Okay, so you can see now lately, partially with the help of the US government, things have taken a turn on this. But when you see payout ratios above 70, 80, 90%, especially if that goes on for more than a quarter, that is that's something you just got to be careful about there, okay? So that's the second one on the list, ignoring high payout ratios. These are 10 things that can hurt your dividend portfolio. Here's the next one. Treating dividends as free money, okay? What do I mean by that? I mean, when a stock comes out with a dividend, let's find a stock that pays a pretty good dividend here. Let me go a little shorter term on this. Let's go to, let's say Verizon. Verizon pays a pretty good dividend. If you ever want to check the dividend, you go to the trade tab. You can, let me just move that out of the way. You can click right here, 6% yield. When Verizon comes out with a dividend, you can see this here. When it comes out with a dividend, about a 70-cent dividend, the stock is going to drop, everything else being equal, by about 70 cents on that dividend X date. Okay? 69-cent dividend, the stock, everything else being equal, would drop about 69 cents on that day. Now, sometimes you don't always see that because there's a big rally on the market, and in that case, the stock would go up 69 cents less than it otherwise would have gone up. But that value is taken out of the stock. That is why, if you're a dividend investor, you can't just go ahead and, oh, I'm going to buy right before the dividend X date, be entitled to receive that dividend, and that's not free money in that regard. You can't do it. It just doesn't work that way. Now, the stock may go up or may do that over a shorter period of time or not, but there's an equal value in the company before and after the dividend is released. It's either all in the stock price or it gets released some in terms of cash, that is the dividend, out to the investor. But the net value is going to be the same. So don't treat dividends as kind of a free ticket to good returns. You can invest in dividend stocks all you want. It's not a guarantee of better performance there. Next one, neglecting dividend growth. Very often, traders will take an approach of investing in things like dividend aristocrats. Those are companies that have paid out increasing dividends 25 years in a row. Now, maybe you don't invest in a dividend aristocrat. That's okay. You don't need to. But increasing dividend payments over time is a sign of is a positive sign typically for a company. The company is willing to pay out more money to shareholders over time. And if they can't do that, that could be a concern if the dividend just stays constant over years. So a lot of investors treat that as kind of a positive thing about a company. On the Thinkorswim charts, you can see the dividend here in this green, the little dollar sign, green, 65 cents, 66 cents, 66 cents, 66 cents, 67 cents, 67 cents. And so as you go, you can 69 cents. So it's going up a little bit there. You can look at other companies and you can look longer term on this. Let me go to, I don't know, a 5-year chart, and let's look at, I don't know, let's do Microsoft. Here's Microsoft. You can look at that dividend. It may be a little bit hard to see, but trust me, if you can't read that number, it says 56. And then usually it'll stay steady for 4 quarters and then go up 56 and then to 62 and then to 68 to 75, 83, and 91. That's an increasing dividend amount, an increasing dividend payout. And that is generally perceived to be a good thing for a company. When you are looking to buy new dividend paying stocks, I would encourage you to look at the company's history and look for increasing dividend payouts. Now, if you're on the Schwab.com website, let me just bring that up real quick, and you're looking at a company, and let me just go to, we're going to pull up the stock here. What should we do? We'll do, I don't know, Apple. Here's Apple. If you look at that stock and you scroll down on it and you want to look at the dividend history, here's dividends. This is incomplete though. You can see more information if you click on Show More. If you click on Show More, then you can look back over time and you can see what that dividend payment has been over time. Okay, so you can look at the history there. So that's just pay attention to that. A lot of investors are what you'd call dividend growth investors, in that they look for growth of dividends over time as we do this. Now, on our list of 10 things that are going to hurt your dividend portfolio, let me bring up one that I'm not going to talk about a lot today because I'm not a tax advisor, but I think I would be remiss to not mention that you should consider taxes with your dividend growth, with your dividend portfolio. Holding high dividend paying stocks, it can make a difference what kind of account it is in, whether it is in a tax advantaged account or a non-tax advantaged account. You're going to need to talk to your tax advisor. I can't get into the details of it today, but when you think of dividends are either qualified or non-qualified. Non-qualified dividends can be taxed at a higher rate than qualified dividends. Okay, I'm going to leave it at that. REITs, real estate investment trusts, business development companies, typically those are going to be non-qualified with not as good tax planning. So do your tax planning. That's all I'm going to say about that. It can make an effect. It can have big effects on your portfolio long term when you're considering those dividend. If you have a dividend paying portion of your portfolio and a non-dividend paying portion, some traders will look at just make sure you do your tax planning on those. Okay, talk to your tax advisor on that, and you can do some more research on your own on that. Okay, here's another one. Over concentrating in one sector. Okay, this can be a challenge. Now, why would you over concentrate in one sector? Well, very often there's some sectors that tend to pay higher dividends. So for example, the utility sector tends to pay higher dividends than other sectors. Let me just go back here and let me just double check here. Oh, by the way, there is a survey in the chat. So we appreciate your feedback. Just survey's quick. There's like just two questions, and then there's some opportunity for some feedback or suggestions, things like that. So encourage you to fill that out. Okay. Trevor in the chat said, is there a way to give a dividend picture on the long-term chart to get price plus dividend? Yes, I'm going to share that with you in just a little bit. So Trevor, just sit tight here for a little bit and we'll get to that shortly. Okay. So let's go back to to number 6 on our list, over concentrating in one sector. It may seem to just make logical sense to have a portfolio full of utility stocks or stocks in one particular sector because they're the ones paying the higher dividend amounts. Maybe financials sometimes pay more dividends. However, keep in mind, if you concentrate into one sector, if that sector gets hit hard, it can disproportionately affect your portfolio. I'm not saying you need to equally distribute into all 11 sectors or anything like that. What I'm saying is just be aware of your concentration into any particular sector and the risk that goes into that concentration of that sector. We've seen this lately. Sometimes, well, you can see it almost any time in the market. Some sectors outperform others over time there. Okay. Here's another one that I want to just point out to you. Number 7 on our list here is reacting to price instead of fundamentals. Okay, what do I mean by that? What I mean by that is this. There's a lot of reasons a company can go down in price. If you look at the markets, let me just do this. Let me just pull up the S&P 500 equal weight, SPXEW, okay? When the market is pulling back, this is the S&P 500 equal weight, okay? When the market is pulling back like that, the vast majority of stocks are probably going to be pulling back at that time. Now, this has been kind of a weird pullback because we pulled back and then it really strongly recovered. It doesn't always do that. We can go, longer term chart and look at longer term pullbacks if we want. And in fact, if I do so, let me just switch this to a 3-year chart, okay? Well, here was a pullback. This was the so-called tariff tantrum, okay? Pullback from, it didn't last that long, from November to the beginning of April. But during a period like this, that certainly, most stocks are going to be pulling back during that time. If you look at your individual dividend paying stock and interpret that as, oh, my stock is terrible, it's going down in price, that may not be why the stock is going down in price. It may be caught up in the overall downdraft of the market. So try to distinguish a price drop that's based on fundamental degradation in the stock. And that could be the form of, sales dropping quarter after quarter or plateauing, revenue dropping quarter after quarter, cash flow dropping, payout ratios being elevated for a long time, things like that. Or maybe there's news that you follow in the company. Those may be signs where you should consider changing your portfolio, but just an overall market drop may not be sufficient reason to do that. And and this is true for either dividend investing or any kind of investing. When a stock is dropping, it may not be because of the stock. It may not be because of a bad earnings. It may be because the whole market is dropping. So just be aware of that. All right, let's move forward. Okay, number 8. For getting to reinvest dividends. Okay. When you own a company and the company pays a dividend, That's cash coming into your account. That's wonderful. Well, if we have cash coming into your account, then what happens to that cash? Well, it may very well be put into a cash account like a money market. Well, how much money are you going to get paid in your money market? And especially over time, and of course, any one dividend payment may be very small, but over time, if you just let the cash build up in that money market, that may or may not, I don't know, but it may not be the best move, best place for your money in the long term. So something you can do is you can do a dividend reinvestment plan of some sort. So for example, let me bring up my Schwab page again. And you can't do this in the Thinkorswim, but on schwab.com. Now, I don't have any positions in this. This is just a dummy account, so to speak. But on schwab.com, if you go to accounts and go to positions, and if you do so, what you're going to see is, let me just do this. Under position details, in this area, so under position details, it will list out symbols. Okay, here's symbol X, Y, X, Y, Z, or whatever, it doesn't matter. Okay, so it has different bits of information, quantity, price, etc. There's this right here. And it's either going to say yes or no. It'll say yes or no. It'll be a clickable link. You can click on it. If it says no, you can go through and you can then reinvest the dividend. If the particular company pays out, let's say it pays a 2% dividend, which is a fairly standard dividend. That means basically 0.5% is going to be paid out quarterly for that company, 4 quarters in the year, 0.5% each quarter equals 2% for the year. And instead of being pushed into just a cash account, it's going to be pushed and it will reinvest and you'll end up buying more of your stock, which for a lot of people they would say that's probably a better use of your money than in the money market account. There are times when cash in a money market account may absolutely make sense. But just long term, for a lot of stocks, consider these DRIP programs, DRIP, it stands for Dividend Reinvestment Program, as a potential benefit for your portfolio there. Okay? So that's number 8. We got 2 more. Number 9. Ignoring total returns. Okay. Trevor asked something earlier. What about looking at total returns as total returns on your portfolio? Keep in mind, you can get paid a few percent in a dividend during a year, which is great, but if the stock price does nothing, that may not be your best investment. Now, you don't know what the stock is going to do, but you hope it's going to go up. You plan for it to go up. You try to find stocks that you think are going to go up. Over the long haul, it can make a huge difference. Let me bring up AT&T. So here's AT&T. Now, and I'm going to go to a 5-year chart on this. Here's a 5-year chart on AT&T. And you can see 5 years ago, the stock was around 22, 23. Right now, it's about 20, 26. Okay? That doesn't sound too good. A couple ways to look at it. One is, if you go to chart settings and you go to equities, you can adjust for dividends. Now, I'm not adjusting for dividends right now. Remember, when a dividend gets paid, the stock is going to drop by essentially the amount of the dividend. If I adjust for dividends, make that all. Let me just move this out of your way so you can see it. Now look at what we had. Adjusting for dividends, that's looking quite a bit better there as an example. Now I'm going to go back to not adjusting here for a second. I want to show you a different way to do it. There is a script, and the script you can add to your Thinkorswim charts if you like. I'm going to share the script with you. I'm going to share it in the chat. I just put that in. Remember that scripts aren't guaranteed for accuracy or timing. Okay? Just remember that. Number two, what does this script do? Well, let me show you. I'm going to go up here, and I'm just going to get rid of that and that. And I'm going to go to a script, and it's called Dividend plus Price Appreciation. Oh, no. I think it's under T's, total return. There we go. Okay, apply. Here we go. Now, when we look at this, when we look at this upper left portion of the page here, we can see price return over the past 5 years for AT&T, about 11%. Okay, that's nothing to write home about, so to speak, over 5 years' time. Dividend return about 28%. Total return about 40%. Look at the massive impact dividends have made on terms of the total return here on this. So let me do this. Let me clear that out, and let's just look at a few other random companies here. Microsoft, okay, not really considered to be a massive dividend company. Price return 5% price return over the last 5 years, 60%. Dividend return about 5.5%. Not a huge difference there on that. What about, say, Coca-Cola? Price return 37%, dividend return 17%. That's a massive return over time difference, okay? And so when you are considering your investments with dividend stocks, consider both aspects of it, because I know there's been times when I've looked at a stock that I've held, and I've looked back and I've looked at the price and I've gone, I'm a little disappointed perhaps in the price. But then I've thought, you know what? I've held this company for X number of years, and I've gotten this quarterly dividend every quarter from this. That really has made all the difference sometimes in terms of these things. So hopefully that script there. This is for the time frame that we're on. This is a question from John. So this is a 38% return over the last, in this case, 5 years. If I switch this to a 1-year chart, do you see it switches the numbers there? So kind of a slick, little, study that you can add on there if you want to see the total return. I think it's one that, you certainly may consider there as you're using that. Oh, by the way, I added that script. There's the two scripts. I've added them to the chat. I also added them to the description of the webcast. So if you're watching on a recording, you can just look at that description there. Okay? All right. Trevor says, hey, let's look at some others. Altria. What do we got? That's 1 year. Let me go to 5 year. Because 1 year, let's realistically, there's not that much difference over 1 year. Price return, 36%. Dividend return, 40%. Okay, total return, 77%. Most of the returns have been in dividends. Well, this is a company that is kind of known as a big dividend payer. There's a few of those big dividend payers out there Verizon is a big dividend payer. Price return, minus 19%. Dividend return, 24%. So over the last 5 years, Verizon, 5% return, that's not a great return. But I'll tell you what, it would have been a lot worse if it didn't pay that dividend there. So there we go. Okay, let's go to number 10 here on our list. Number 10 on our list is blindly following buy and hold. Okay. I don't want you to misperceive what I'm trying to say here. I'm not by any means anti-longer term investing. When we're talking about investing in dividend stocks, I'm assuming for the most part, we're talking about longer term investments. Okay. Dividends for one particular quarter just may not make much difference. But there's times when you need to realize, even if it's paying a good dividend, even if it's a company you like or the stock's been doing okay, for a little while, not just to have a buy and hold forever attitude. Let me mention a couple companies that you may be familiar with. JCPenney. You guys remember JCPenney? JCPenney was a big, consistent dividend payer in its day. Okay? A lot of people bought it for its dividend. Can't bring it up. I can't bring up a chart to show you. Sears. Okay? Sears was a big dividend payer in its day. And that's why a lot of people invested in it. If you took a buy and hold mentality on this for long term, without regard to changing business environments, if the business model is failing, then it doesn't make sense to stick with the dividend. Let's look at GM here for a sec, because GM as a company has done great recently. It has done pretty good recently. Let's go back though. Here's what I want you to see. Here was the dividend payments. Let me just kind of zoom in here. Okay. 25 cent, 25 cent. We're back in 2006, 2007 time period. Okay. 25 cent, 25 cent, 25 cent. Let me just scroll forward a little bit. 25-cent dividend. The stock was about 30, 35, something like that. Oh, lo and behold, notice what happened, 25-cent dividend. Notice those little green dollar signs on the chart go away. They actually ended up cutting the dividend. There is no dividend. There wasn't a dividend anymore on that. Okay? So there you go. And you can see what happened to the stock. Now, it's had a great turnaround story on General Motors, but it's just a warning there. You may like a brand, but don't fall so much in love with the brand that you're become blind to a business model that isn't working anymore. And so just be aware of that. And so that's my kind of warning here against buy and hold. I'm not opposed to long-term investing by any means, but this is the key word right here. Blindly following buy and hold there. Okay. Let me hit up some questions and then we're just about out of time. Okay. So there's the 10. If you wanted to jot any of these down, you're welcome to there. Okay. Emmanuel asking about qualified versus non-qualified dividends. I can't talk about it. I've gone into as much tax as I can talk to on that. And so there's some easier answers and then there's some nuance too to the answers. And I can't get into that. So you can Google it, obviously. Obviously, your best resort is probably to talk to a tax advisor on that. But there's some relatively simple answers that will come up if you Google that as well. So what question from Barbara? What would you use other than cutting dividends to use to sell long-term holds? Changing fundamentals would be the main thing. Okay. Changing fundamentals. What do I mean by that? Revenues that start declining. If the company can't pay, remember, dividends are coming out of earnings. And if earnings are going to be threatened, then the dividends may not come and the stock price may drop as well. So that could be the bottom line earnings itself. It could be top line revenues that are changing. If payout ratios start to not just go high for a quarter, but start to just get higher and higher, that could be a challenge there as well on that. Those are kind of the main things. If the dividends, and you mentioned this, if the dividends are starting to, you don't get the increases, that's why a lot of people like that dividend growth investing approach there. Okay. Now, everybody, I want you to have success in your portfolio. I think if you consider these 10 items and you're a dividend investor, it can only help you. It can only help you out. I do appreciate you joining me today. I encourage you to subscribe to the Trader Talks channel. You're probably on YouTube right now. If you haven't subscribed, you're on the Trader Talk, you're watching this on Trader Talks, subscribe to the channel. You'll get our content that is of interest to you, okay? There's millions of videos out there on YouTube. You want to prioritize and see the stuff that is of interest to you, okay? So please make sure you subscribe to this channel. Also, I would appreciate it if you liked this, if you'd give it a thumbs up, okay? If you give it a thumbs up, it helps to promote the video, helps to promote free education, helps to help me out. So I do appreciate that. And, keep in mind, someone else, Stephen mentioned, hey, you can do ETFs. ETFs are a possibility as well. I'm not going to talk about ETFs today, though. All right, everybody. Thank you for joining me. Remember, there was a survey link in the chat. If you would fill out that survey, we would appreciate you on that. And in fact, we'll just pin that up there. How about? And everybody have a nice rest of the day. Coming up next, we've got Trading the Trend. Have a wonderful day, and we'll see you down the road. Bye-bye, everybody.